So as far as debt PMS is concerned, the first thing that you must remember, it is allowed to invest only in listed rated papers, which means that you're investing in a paper which is transparent, you know about the paper, and therefore you're investing.
So, hello everyone. My name is Vikas Agrawal. I am the founder and CEO of Alternate PMS Experts India. As we speak, we are emerging as one of the largest platforms for investing in alternate investments and portfolio management services. So, at AIF PMS Experts India, we keep organizing these knowledge-based sessions, and the whole idea is to educate and empower the investor community as a whole. And therefore, we keep inviting experts from our industry, and the idea is to read their mind. Understand what do they think about it, about the asset class, and how do they add value. So with me, I have the Chief Business Officer of Sundaram Alternates, Mr. Hitungshu Debnath. He brings about almost 3 decades of rich experience when it comes to investing, having worked with large organizations like Tata Mutual Fund, like Motilal Oswal, like HDFC Mutual Fund. He was the earlier one who starts a mutual fund promotions when today, like where AIF and PMS is, a mutual fund used to be in those days. So he would travel to CAT 2, CAT 3 cities and talk about the advantages of investing through mutual funds and participate in capital markets. And that's how the journey began. And he also worked with a couple of wealth management companies. He also run, fintechs in his previous avatars with other organizations, and now taken over as CBO. He has an excellent track record of turning the companies into profitability. So with his great understanding today, we want to read his mind about how alternate investment industry is shaping up, and he took over as CBO under the alternate arms of Sundaram Mutual Fund, the asset management company. We'll talk about that more in detail. So Hitungshu, over to you. Thank you so much for joining us.
All right. Thank you, Vikas. Thanks for inviting me. Just a little modification in the topic which you mentioned, actually. It is about an alternate strategy that we're talking about here, which is investing into debt PMS, which is our offering at the moment that has come up on board. Before I start, I just want to set a context here. One of the largest fund managers, I heard him speak when he said that the biggest worry that he has is about the valuations in the industry today. The stock market seems to be valued pretty high, and therefore time has come to think as to what kind of strategy one needs to follow. So this interesting statement that he made is that the only fund that is promoting right now is the multi-asset fund. What it means is he's investing money not only in equities, but he's also allocating his monies to debt and gold as well, right? So he's doing it inherently within the fund, but here is an offering that we have from Sundaram Alternates, which is called the fixed income rated short-term strategy, which is for allocating incremental assets or money into debt as a strategy, which I'm taking off from what Vaibhav said in the previous presentation, which he said that risk-adjusted return is very critical to sustain your investments for long periods of time. So I'm just setting an agenda quickly so that we get an understanding where we're going with this. What is the significance of yield enhancement? What is the debt PMS strategy? How does it work in comparison to other products available in the market? Is it the right time to enter? And what about Sundaram First as a product, and what are the strategy specifics that we have? So,
can you make it full screen? Sorry to interrupt.
Sorry.
Yeah. Make it full screen. Yeah.
Can you see it?
No, make it slide view, full screen.
Yeah, I did that. Yeah, I've done that.
Okay, so maybe it takes.
Not coming through?
No. Manvi, can you check why is it not coming, the full screen? I think, okay, she's just checking.
Yeah.
I think you have to click on the bottom right, just slide view. Acha, you did.
Right. I've done that, yeah.
Okay. Yeah, slides are moving, Manvi, but we need a full view.
Is it showing now, full slide?
Yeah, you have to make it full screen. She's saying that.
I know. I've done that, but it's not coming on the screen, I guess.
Okay. Sure.
Is it?
All right. I think it's visible. Slides are visible, so we can continue with your presentation. Over to you.
Okay. Should I continue?
Yes, please. Please continue.
Okay. Now, the significance of yield strategy that I'm talking about. 1 minute. Is the slide moving, please? Can you see the slide moving?
Yes, very much.
Okay. So the significance of yield enhancement strategy is basically that when you allocate an asset, some bit of money to a debt strategy, the idea is to get a high yield return for the risk that you're taking. So you invest in papers or funds, which gives you a higher return for the risk that you're taking. The potential to get an income on a month-on-month basis or a quarterly basis is something that this kind of a strategy offers, wherein you're taking out money for the investment that you're making on a monthly basis, on a quarterly basis, or there is a chance that you can also make capital appreciation depending upon the interest rate scenarios that presents itself in the current scenario that we're seeing right now. The possibility of getting a capital gain as well is possible in this kind of a strategy as a thing, and getting a risk-adjusted return which is attractive for the risk that you're taking. So this is one of the significant benefits of investing in a high-yield strategy in the debt side of the business. So we just have a quick overview. Given the fact that you're getting into a debt PMS, you're basically investing in debt instruments, aiming for stability and regular returns by taking optimal risk and thereby trying to maximize your return. So the balance between risk and return is something that you can actually achieve in this kind of a strategy. Among the other things that we're talking about, which is diversification, transparency, risk management, professional management, all those things, the most important thing that debt PMS offers is customized solution. What I mean by this is, since debt PMS is an individual separate account kind of a setup that you have, for each customer, you can actually design a particular strategy. For example, a customer would come with a 1 crore money saying that I want to be on the aggressive side of the debt strategy. So we could pad up his investments with more BBB rather than more AAAs. Or there's a customer who would say that I want to balance between the risk versus return, rather be a little bit more conservative. Then I would rather go more with the AAAs than with the BBBs. So this is not possible in a debt mutual fund or a single paper debt paper that you could do this. So, or a Cat 2 or a Cat 3 AF you can't do because you can't have customized portfolios there. So just giving a quick comparison of a debt PMS versus the other products available in the marketplace. You can see I'm comparing with debt PMS, Cat 2, Cat 3, and debt mutual fund and single security. So as far as debt PMS is concerned, the first thing that you must remember, it is allowed to invest only in listed rated papers, which means that you're investing in a paper which is transparent, you know about the paper, and therefore you're investing, you know fully well where you're investing. Whereas in a Cat 2 and Cat 3, it can be in an unlisted paper. Underlines, you wouldn't know the complete details as much as you know in a PMS structure. Similarly, in debt mutual fund, it is very transparent. You know you're you're investing in a listed paper, which is only allowed in that kind of situation. So the flexibility of the tenor is possible. In debt PMS, you can invest for as less as 6 months if the strategy offers you that, or you can invest as long as 6 years as well. And it's a pass-through vehicle. Diversification is completely possible because the debt PMS can offer you anywhere between 5 to 15 securities per portfolio. So therefore, automatically, inherently, it is diversified, and it's very transparent because you know exactly where your money is going, and therefore you know what kind of papers you're investing and what kind of returns you can expect from them. And the last point, which is the most important point that I feel is very critical to debt PMS, is the customization of the portfolio, which is not possible in any other thing. This is the killer difference between debt PMS versus the Cat 2, Cat 3, and the debt mutual funds that is on offer. So that's the biggest benefit that you could see. Just pushing the point a little more, is the return predictable? Yes, because I know exactly what papers I'm going to be investing in, and therefore I know what kind of return that I can expect, unless and until there is some kind of huge risk that has happened or a huge event that has happened, the whole thing can change on its head. But otherwise, you can see what kind of returns that can be predicted from the portfolio is easily possible. The return profile is moderate to high. Holding type is medium to long. Risk is slightly on the higher side, primarily because of the fact that you're willingly taking a higher risk in expectation of better return than the traditional products that are available in the marketplace. Liquidity is moderate, not as liquid as debt mutual fund, but yes, because you're going up the risk ladder, the kind of papers that you're investing, the liquidity to that extent is much lesser, and therefore it can be liquidated, but there could be some impact cost in that on those papers as well. So returns that I'm positioning here for you is here anywhere between 9 to 13%, which is basically it's a fixed deposit plus or an income or a mutual fund plus kind of return that one can expect. Wherein the real return post-tax, post-inflation could be about 100 to 200 basis points over and above the traditional return that you get. The benefit here in mutual and debt PMS is that you are subjected to marginal tax on the interest income. And an interesting aspect is that the long-term capital gain tax on a listed rated security is 12 months and 10% only. So that is one biggest benefit that you'll see. That's what I'm trying to show here, the benefit of taxation. If you're holding a capital assets, and if you're holding it for more than 12 months for a listed rated corporate bond, you're subjected to only 10% tax. So this is a huge tax arbitrage that is available. And if your PMS strategy is trying to take advantage of a situation like this, your liability on tax drops dramatically from your marginal rate of tax to long-term capital gain tax of only 10%, and that too within 12 months of holding. So just to give you a quick idea of how the return differential comes from the traditional products that we typically look at, the FD and the debt mutual fund. The return differential post your expenses and marginal tax rate between the fixed deposit and debt mutual fund is anywhere between 2.5% to 3% over and above post-tax, post-expenses. So that's a huge differential for customers who are investing large sums of money or allocating large sum of assets towards debt mutual fund or vis-a-vis a debt PMS. So the incremental differential is pretty much obvious out here. So if I had to show you the positioning of the debt PMS vis-a-vis other products, here is what I could show you, the risk versus return matrix that is here. A traditional product, mutual fund and debt PMS is anywhere between 5 to 9%. Debt mutual fund is between 5 to 9%. A CAT2 and a CAT3 is anywhere between 13% and above. It can go up to 20-21% depending on the fund that you are investing. Debt PMS has got this sweet spot here right in the center between these two products, which is between the 19 and 13%. So based on the benefits that you saw in the past two slides, the risk return reward that you get from a debt PMS far outweighs from the other products that is available from in the market in the debt space, and that can add to a benefit to your benefit to your portfolio that you're looking at, right? So I'm not saying that the other funds don't have any advantages. They do have their own advantages and disadvantages, like the debt PMS would have its own. But that sweet spot of 9 to 13% is what debt PMS can fulfill in your risk return matrix that you're looking at. Asset allocation, since you're looking at a high yield return from the debt side, it has definitely a kind of allocation that is required in your overall portfolio, in addition to the other products that you might have, maybe about a 10 to 15% kind of allocation that you can give to your overall portfolio. Who should be investing in this fund? Typically, I would expect a HNI or ultra HNI who has surplus money and is looking for a monthly or a quarterly coupon payout that comes as a cash flow to him, or a corporate treasury or a pension or insurance company who want to get better yields than what they get in the mutual fund, the traditional fixed income securities that they're investing in, is something that they can look to invest in this product. And what are they investing for? They're investing for basically getting a yield kicker on the existing debt portfolios that they have, and therefore getting a better return for the risk that they're taking in this strategy. So what is the timing? Is the timing right? So typically the question being asked is this the right time to get into the market? Like I said, the fund manager who I quoted in the past is currently worried about the valuation of the fund, of the market. Are we in the right place at the right time? And therefore, the typical strategy would be to take off the profits from the table, keep the principal back in the market, and take the profits and put it in a high yield strategy. So in that sense of the term, the timing is good. But investing in a debt strategy, is it the right time to do that? Is something that one might want to ask this question. So if you see from the quality perspective, this is the CareEdge quality index since 2012. It's been tracking, and you'll see the underlying papers of 1,600 companies covering about 50 lakh crore lending that has happened. The quality of the paper, underlying papers have been improving. So that is something, it's a good news. Therefore, the worry about the balance sheets of the company or the underlying companies are improving and getting better by the day. And therefore, it is a good time to enter into the market. As far as the interest rates are concerned, you'll notice that the interest rates are peaked out. Expectations are in the next 6, 8 months or 12 months, the interest rates might start mellowing down, subject to the inflation situation that is there in the country today, and globally what the US and the European markets are going to be doing. So the opportunity that is presenting itself in front of us is basically telling us you can lock into high yields and play the interest rate cycle as we go along. And the window that is available is between the next 6 to 12 months that is coming up for us to actually lock in these yields at this point in time. So timing wise, it is very, very appropriate. And therefore, you're aiming to get about 12 to 13% return should be very easy. This is the basic graph to show that the 1-year AAA corporate bonds, 3-year AAA corporate bonds, and 10-year G-Secs all at its peak at this point in time. So therefore, you're entering at this level and booking yourself and locking yourself in for the next 2 to 3 years is an appropriate thing that you're going to be doing. So just a quick introduction about our fixed income strategy. How does it help investor to get into this? It's a short term. It is for a 3-year tenor is what we typically advise for the customers. It invests in non-convertible debentures, listed corporate bonds, preference capital, and commercial paper. And it is investing only in rated and listed papers as mandated by the regulations. Primarily we focus on the hold to maturity strategy. The focus is on income generation than capital gains. Though if capital gains comes along the way, we will ensure that we make profits in that to book it to the advantage of the customer. And the focus is in a risk-adjusted return with a diversified portfolio, which is aiming to give periodic income distribution. That is the main thing. And capital preservation is one of the main strategies that we follow in this. What we do, we hunt for high yield opportunities. We conduct a credit analysis. We ensure the portfolio is diversified adequately, and we have a proper risk management system to ensure that proper parameters are checked, and ensuring the risk is minimized to as much as possible also ensuring the yields are enhanced in these strategies. What are the strategy specifics that we have? We have 3 strategies here: conservative, moderate, and aggressive, depending on the kind of the portfolio or then the profile of the customer is. On the conservative, predominantly be towards the AAA and AA minus, AA plus and AA minus, targeting in yield of about 9.5%. Moderate is in between conservative and aggressive, targeting an yield about 10.5%, and aggressive predominantly more towards the BBB side, targeting an yield about 12.5%. These are the 3 strategies. There's a flexibility and customization that I was talking about that is possible as far as the debt PMS offered by Sundaram here. So here I'm just trying to position a debt PMS strategy in comparison to SBI 3-year fixed deposit, which is a standard benchmark for fixed deposit that we're talking about. We are trying to position this product. We are positioning this product as typically fixed deposit plus product, right? So we did a back testing of this product, of this yields for the last 4 years, starting from Jan 2020 to Jan 2024. You'll see the SBI fixed deposit was from 5.7% to 6. Sorry, this is the one. Yeah. So it ranged from 6.7% to 6.76% out here. Whereas our portfolio, when we did back tested the portfolio, the aggressive portfolio ranged from 10.42% to 11.68%. Assuming the fact that the fund manager is able to generate an additional alpha because of the capital gains, and he's able to add about 50 basis points, this goes up to 11.68% or closer to 12%. The yield differential you'll see ranges from 4.83% to about 5.13%. So the differential that you're talking about between a standard fixed SBI fixed deposit 3-year deposit and our portfolio, the aggressive category, ranges from 450 basis points to 650 basis points. That's a huge differential that we're talking about here. So the standard offering details that we have is that a strategy that we're following is about hold to maturity with a little bit of capital gains that we're looking at. We're looking at listed and rated debt securities ranging from AAA to BBB kind of papers that we want to invest in. The management fees for conservative is about 75 basis points, moderate is 100, and aggressive is 150 basis points. And the exit loads are 3 to 1 for 1 to 3 years. The indication that we're giving is minimum tenor one should look at. It's about 3 years for investing into this thing. The average modified duration of this portfolio will be between 2.5 years to 3 years, and coupon payment would happen on a monthly or a quarterly basis depending on the underlying portfolio that would have. And the minimum investment amount we're looking at is about 50 lakhs. So that brings us to the end of the presentation, which is our debt PMS strategies, a new innovation that we bought from Sundaram Alternates. And we think the time has come for every investor to start thinking about the fact that after having participated in the market rally that is in the equity markets, time has come to now start slow back a little bit and think how to allocate a bit of money towards the debt side so that you have a diversified portfolio and you're not predominantly exposed to equities. And God forbid, if something happens in the equity market, you might be wondering what happened to your portfolio. So instead of having 80 to 90% exposure, time has come to start slowly allocating at least 10 or 15% of your overall portfolio in this debt strategy on a high yielding strategy and locking it at the right time, because the market is giving us the opportunity to get into a high yield strategy right now. So with that, I close my presentation and over to you, Vikas.
Yeah, thank you, Hitungshu. It was a great presentation. A lot of insights about what's happening in debt markets, and I agree with your point is that strategically it is a time that you allocate more towards debt funds because equity markets have given good amount of run up now, and it's very important that we keep looking at the allocations time to time because most of the time we tend to forget that, and then you don't get to know that when equity exposure goes up beyond your overall scheme of things.
Correct.
So thank you so much. Great. Probably we have Vikas also tomorrow joining the session from here. So
Correct. He is too. Yes.
able to hear more from him about how you run the strategy, etc.
All right.
It was a great
Thank you, Vikas. Pleasure being there. Yeah. Thank you so much.